Now, the minutes yesterday revealed that all members agreed that more rate hikes are needed to tame inflation, but there was also a suggestion that it could be smaller rate hikes than what we've seen. Joining me now is Independent Advisor Alliance Chief Investment Officer Chris Zaccarelli. Chris, great to see you. Thanks for being here. What did you take away from the minutes yesterday?
Yeah, I thought the minutes were interesting. There was a lot of talk about the Fed getting more hawkish in terms of potentially doing 50 basis point rate hikes again. But as you mentioned, 25 seems to be the consensus. And so I think the Fed is going to continue to move forward at that 25 basis points pace. But what's going to be different is coming into this year, a lot of people thought they'd only do 1 or 2 rate hikes. We're now seeing they're going to do at least 3 for this year and potentially a little bit more. So the Fed is going to go higher than people expect, and I believe they're going to hold those rates to the end of the year at a higher level than people expect.
Yeah, but I mean, there's a lag in terms of the impact that these rate hikes are having on the economy. We've got the second read of fourth quarter GDP out this morning. It's out at 8:30 a.m. We're expecting growth, 2.9% growth in the quarter. Chris, when do you expect these higher rates to start catching up with growth, and are you expecting a contraction this year?
Yeah, it's taking a really long time. I mean, they always say there's, long and variable lags with Fed policy, but I think all of us going through this process, seeing rates go so much higher, consumers remaining very, very strong, unemployment remaining low, it is taking a long time. I do think the Fed ultimately is going to continue raising rates until they cause a recession. So the timing is still a little bit uncertain, but I do think at the end of this year we'll start to see things deteriorate. It's really the strength of the consumer, the amount of money that everyone had coming out of COVID that is really prolonging this cycle. But if the Fed wants to keep raising rates until they slow the economy down, I wouldn't fight the Fed. They're going to continue to do that, and we will see a slowdown either at the end of this year or beginning of next year. Yeah. But I think things are starting to slow down as you start to see more and more companies laying people off. Unfortunately, higher unemployment will be one sign that we're getting closer to the end of this cycle.
Yeah, good point. Mark Tepper, jump in here, because then there's the earnings story, right? Are we already in a profits recession? We've got fourth quarter earnings underway. Moderna, Wayfair, Alibaba, Keurig, Dr. Pepper, all up before the bell this morning. Then you've got Warner Brothers Discovery and Carvana, Beyond Meat after the bell. Mark.
Yeah, I mean, it seems like we are in an earnings recession. Obviously, the earnings that the market looks at are slightly negative year over year. But when we talk about GAAP earnings, and we talked about this last week, Maria, that was down like 20% year over year. So we're definitely in an earnings recession. And I was reading Chris's notes this morning, and he made a comment about how investors continue to run in and buy the dip because they've been conditioned to buy the dip. Ever since 2009, we've been in this easy money kind of regime. I've been referring to that as recency bias. Investors seem to have a short-term memory. They only do what they knew how to do last year and the year before. Chris, I would love for you to talk a little bit about that.
That's a really good point. Recency bias is something that affects all investors, and I think you're exactly right to the extent that we've had easy money for so long. Interest rates close to zero, quantitative easing in the scale of trillions and trillions of dollars. The Fed balance sheet got as high as $9 trillion. They're now bringing that back down. So it's not that higher interest rates or taking money out of the economy will instantly puncture this inflated earnings picture, but over time it has to have an effect. To the extent that everyone was able to buy the dip, the Fed was your friend for the last, call it 13 years, that trend is reversing. And so now, if anything, I think as the market goes higher, the Fed is looking to actually knock the market back down. Maybe not as aggressively as they did last year, but in general, a higher stock market with low unemployment, higher spending, all those things lead to higher inflation. We all know the Fed is fighting inflation. So the question is, which of those things, if not all of them, are they looking to contain? And so I would say, as a stock market investor over the last 12 years, buying the dip always worked because the Fed always came to your rescue. Yep. This time around, it's a little bit different because the Fed isn't coming to your rescue, and to the extent that things are different, it's really back to the old normal, the normal that most people knew prior to the financial crisis, of which companies had to stand on their own 2 feet, and the Fed wasn't there to just stop the stock market from falling 20 or 30%. Yeah. The market's going to go where the market's going to go. The Fed isn't there in the way it has been over the last 12 years, and I think investors need to get used to the old normal as opposed to what they've been most recently used to.
Yeah, especially since the Fed is also unwinding the balance sheet, as you mentioned, and that's taking $1 trillion out of liquidity. Thank you. That's terrific. Great to get your insights. Chris Zaccarelli joining us this morning. Thank you, sir.